After putting your money into the stock market, you must be wondering, what do I do next? Well, the short and simple answer is to relax and let the stock market do its thing. Of course, this is an extremely oversimplified answer that doesn't actually answer your questions. So, without further ado, let's dive into 5 things that you need to know when investing in the stock market. Number 1. Learn to invest without your emotions. Professional investors are masters at controlling their emotions within the stock market. Just because a stock has dropped 5% does not mean it will not go back up 5% and more in the next few days. With this being said, you should learn to detach your emotions when investing. The stock market does not have emotions, it does not make rational or irrational decisions based on market transactions or behaviors. Consequently, you should try your best to do the same. When you realize that another company's stock is rising through the roof, making incredible gains of tens or hundreds of percent, sit back and think about what you want to do. Are you willing to FOMO into the stock? For those that don't know, FOMO means fear of missing out, and for many new investors, FOMO is a deadly thing for their wallet and portfolio. If you are driven by your emotions, there is a high chance that you will buy into rumors, news, and hype. By doing so, you will find yourself constantly changing your mind and your stock portfolio. Even worse is spending a large portion of your portfolio on a company stock without doing any due diligence whatsoever, simply because you see green wicks on the chart. It may seem like a good decision at first, but once you begin to see a bit of red, you'll begin to freak out and look for any justifications to support your purchase. Before making any rash decisions, try your best to stay calm and stick to your investment plan that you have made, or should have made before investing. As always, if your initial thesis of investing in certain company stocks has not changed, then why sell them? Number 2. You must keep up to date on recent events and company news. One key important aspect when investing in stocks and the stock market is learning about prospects and visions of your invested companies. Sometimes when something goes wrong or something does not quite fit your thesis on why the company will be worth millions in the future, then it may be time for you to swap out of it. The only way to know what is happening with the company is through company reports, earnings calls, SEC filings, and presentations, and also, depending on the company, there may be potentially even more reports. Nonetheless, it is important to stick to information that is official and stated by the company or its board members. Things such as news outlets, social media, and community forums are great places to discuss the company and its potential future, but should not be taken with face value, and in fact, should be taken with a grain of salt. This is because it goes without saying that news outlets, social media, forums, and the like all have their own agendas, and they will not always align with yours. If you see a company that is greatly undervalued and has amazing potential, then, by all means, invest in it. Because not everyone will see the same things you see. Similarly, sometimes you may find bad reports or articles on a company stock that you are constantly holding on to and buying. But just because they are bad reports given by news outlets, these reports should not deter you from sticking to your investment plan. Media is not always right and will always cause a ruckus. They can easily twist company reports through wording and can easily exaggerate something small into something large, whether it be earning reports or board meetings. They want clicks and views to garner money and reputation, and the same goes for news articles and videos. So, whatever the case may be, stay alert and remember your investment thesis. News outlets and media may not always be in your favor. After all, there is a common saying, buy the rumor, sell the news. Number 3. Understand that you cannot time the market. This is an often overlooked and ignored advice. When you hear about buying weekly options or day trading or swing trading, they are essentially trying to time the market to maximize their profits. However, timing the market is nearly impossible, as it is always changing and moving in ways that many just cannot pinpoint. You may be arguing, what about technical analysis? Technical analysis is one approach of buying stocks in the stock market through analyzing a stock's past prices, behavior, and sentiment to predict potential future price action. Technical analysis is surely something that can work and does work, but like everything else in the exchange, it is not guaranteed. You can make more money through technical analysis, or you can lose just as much. If you are interested in learning the techniques for technical analysis, you must train yourself and teach yourself the basics. Then begin to dive deeper into indicators such as the Fibonacci retracement, exponential moving average, and displaced moving average. With this being said, there are a ton of technical indicators, and the more you get into it, the more complicated it will be. Conversely, you may find it easier or simpler just to stick to one or two indicators. Additionally, just because you have learned a lot of indicators does not mean you can predict every stock movement. Of course, the way you invest depends heavily on how far you want to learn about technical analysis. If you are, for example, investing in ETFs or mutual funds, then it is impractical for you to learn about it, as you are investing in a team of people or artificial intelligence that will manage a basket of stocks for you. With the S&P Index Fund or the Vanguard Total Stock Market ETF, it will not make sense to do a deep dive into technical analysis, as these index funds track the entirety of the US stock market. Now, with everything said and done, I am not bashing or hating on technical analysis because I know full well that technical analysis has a purpose. But for the sake of this point, technical analysis has a strong hand in the idea of timing the market. And for many investors, it may not be practical to fall right into technical analysis. Number 4. Learn to diversify your investments and set up a plan that you can change when the time comes. You may have heard of the saying, diversify, diversify, diversify. Many say this because it is true. It is much better to have a diverse portfolio in comparison to a portfolio that is heavily influenced by a single stock. When a sector of the stock market crashes or corrects, it is always a good idea to have investments in other sectors. For example, back in 2000 when the dot-com bubble crashed, it set back many people's portfolios and caused many to go broke. When companies decline as much as 86% of their market value, it is horrifying to watch and absolutely detrimental to your portfolio. But it happened and can happen again in the near future. With investments that are scattered around, your portfolio will not take as much of a hit with a sector crash or correction. Of course, this point does not simply relate to the stock market investments. Rather, if you have investments elsewhere such as cryptocurrency or properties, it is a great idea to have your hard-earned money diversified to those platforms too. Generally, the more diversified you are, the better your chances are of surviving a correction or crash. When you have investments in different sectors as well as different platforms, then you have much more protection against a single sector that is driving the economy down. In fact, this is what millionaires and billionaires do with their fortune. They know that it is infinitely better to have a diversified portfolio rather than a portfolio that is concentrated. This, of course, should be taken with a grain of salt depending on what your investment strategy is. Because after all, it is different to maintain wealth than it is to grow wealth. Number 5. Do some math. This point is a good one if you are holding ETF stocks or mutual funds. This is because since they are relatively diversified, it means that there is not nearly as much volatility for these in comparison to individual stocks. Have you ever done the math for holding certain ETFs or stocks? Have you ever calculated what returns you would get if you held onto ETF A versus ETF B? If you have never considered doing this, now might be a great time. It should go without saying that not all ETFs or mutual funds are allocated the same. Of course, the asset allocation is different, and the weight of each sector within the ETF is different. Moreover, the management fees are vastly different. If you are interested in investing in your country's companies, you can look through a ton of ETFs that cater to that too. By doing some simple calculations, you can find out exactly what your returns would be, or at least to some extent, how much you will have in the future. If you find out that, going through the same trajectory, that ETF A will give you a 5% higher return than an ETF B, then why would you not switch to ETF A? Of course, this should really be done with ETFs or mutual funds, because if you try to do this with individual stocks, you will realize that it is essentially impossible. Considering the fact that each individual stock has a different team, is most likely working towards different sectors, and has a different company vision than another, trying to compare two companies to each other is like trying to compare apples to oranges. Lastly, a note that I should include is that if you do not want to do any calculations whatsoever, then the best and simplest stock that you can hold is the S&P 500. Have you learned anything in this video? Is there something you would like to refute? Let us know in the comments section down below. And as always, remember to like this video, share it to friends and family, and subscribe for more content like this.